Hey everybody, hope everybody is doing well. Well, considering what just happened to the stock market recently, I decided that of course I had to make a video on the markets today. And as you know, in the last couple of weeks have been pretty hectic. I think since the day where I did the outside protest on the strip, the markets have basically tumbled. And I'm not too excited. I lost tens of thousands of dollars. But nevertheless, of course, I'm going to remain very patient and opportunistic, and I am sensing that there's buying opportunities along the way. Now, of course, I told you back in December there is a good chance that we're going to see a correction back in January. Of course, it happened in February, so I was a little bit off. But then again, I didn't think it would be this huge slam dunk correction in a matter of few days. I saw a 10% correction, but I didn't think it would be in a matter of 5 to 7 days. It was going to be in a matter of 1 month or so. But you never know how corrections are, because as you know, they are basically using this coronavirus as an excuse to experience a massive sell-off. And of course, this sell-off is very comparable to what we saw in late 2018, 16, 11, or even 2008 as a matter of fact. Now, of course, the biggest drop days weren't as bad percentage-wise as 1987, but nevertheless, it was a huge mega sell-off. And I guess why are they panicking? Well, obviously, so much of our economy is connected to China, the manufacturing, including, surprisingly, a lot of other goods like prescriptions. China has just so much influence. But nevertheless, a lot of other aspects, such as the overall economy, unemployment, GDP, and earnings, doesn't look too bad. Because remember, the most important thing that you have to really understand, it is earnings. That is the most important thing. And if the earnings start looking good, this is one of the things you have to keep in mind. Now, looking forward ahead, I can see probably a bounce, but I wouldn't be surprised if it's a dead cat bounce. So what that means is that the rebound doesn't take us to the levels. As you can see on the NASDAQ, we were pretty close to 10,000. These aren't levels that we were going to see about a couple of weeks ago. And by the way, 10,000 is double what we saw about 20 years ago. I don't know if you recall, in March of 2000, I remember when I was a little kid, the market peaked at 5,000. So it's kind of interesting we haven't really doubled. We were really close. But again, I do see NASDAQ 10,000 very likely along the table. So, and excuse me for my outside noise. I'm actually in a diner right now. All right, so where's this market headed? Well, I wouldn't be surprised if we make further lows over time. And I wouldn't be surprised if we make, obviously, more and more corrections later in the month. Now, it's pretty likely I do see that this coronavirus thing is overhyped. Will it spill over to the economy? If so, I think it's going to take several months to really hurt the earnings of the companies. But let's take a look at a lot of other aspects. As you can see here, you didn't see a massive decline in a lot of other aspects, but you did see a huge decline in oil, and gasoline prices are falling. And then take a look at this. A lot of gold bugs out there. The Peter Schiffs, Greg Manarinos, many of these other folks like Mike Maloney are saying, oh my gosh, we are right. The market's crashing. The economy's tumbling down. But then again, we have not seen, too much of a huge interest in gold. So you can see here it's relatively flat from the last month. So I guess where did all the money go? Well, a lot of the asset flow looks like it went into, I believe, the bond market. So as you can see here, the bond market really saw some flow coming in. Let's take a look at this chart. Yep. And I believe the mortgage rates hit near all-time lows, so that's one of the things you have to keep in mind. So what am I going to see coming in the future? Well, you have people like Mike Norman that are saying, correct me if I'm wrong, that this is going to be the end of the bull market. Well, that makes sense because this bull run has been going on for about 11 years. We bottomed in the financial crisis in March of 2009. And honestly, I see here's a scenario that's going to play out. I think that there's going to be a rally coming soon. I can see us rally towards August. And I don't know exactly if it's going to be higher than March, although I think it's pretty likely it's going to be the case. I do think that, they're going to threaten to lower interest rates. They're going to pump, who knows, more stimulus. And then we could either peak in August or still January of 2021 is in the table because you remember, it is an election year. These are things that are very important. But certainly what you also have to keep in mind, it isn't just these factors, it's also the earnings report. Now, I want to show you something real quick. Let's take a look right here. And let's see if the earnings of many of these companies are looking good and poised to beat earnings. So you can see here, we have to really see how these earnings really go, because remember, if the earnings are beating lots and lots of expectations, all right, and there's earnings per share, there's total revenue, if they look pretty good, then it's pretty likely this bull market's going to continue. So the reason I have been staying along in the stock market is because I was going to experience, and still under the table, an encore of the last boom that we saw in the 2000s decade, which is basically the real estate market slows down after they raise interest rates or mortgage rates go up. It basically lose steam, it lose number of buyers, then it hits the earnings reports of the real estate sector, and then it starts to spill over the economy in terms of other companies, unemployment and everything, and we saw what happened in 2008. So that's what I am still looking into, but again, you can also look at the dot-com bubble, and we saw that the stock market peaked, tanked, and then the economy fell later on. And of course, then we had 9/11 and so forth. So you have to consider all these considerations in mind. But keep in mind, though, that the stock market got really overheated in the late 1990s. And of course, the percentage gains were much faster, from what I see, than the percentage gains we saw in the last several months. Because the NASDAQ was really looking like a bell curve in the late 1990s as opposed that they are now. Keep in mind, though, the NASDAQ, I believe, depending on how you look at it, it's inflation adjusted about the same as it was in 2000, and adjusted for earnings, it's actually lower than it was in 2000. So anyway, you guys let me know what you think. Thank you guys so much. Please spread this video. Take care.